Hey listeners, we have a really exciting episode today. Tushar Jain from Multicoin Capital came on to talk about the firm's just released proposal to change Solana's inflation mechanism to a market-based approach. Mert and I covered a lot of ground with Tushar to just get more information out there as people try to make up their own minds on this proposal. Although our guest this week is a managing partner of a registered investment advisor, nothing in this podcast should be considered an offer of Multicoin's investment advisory services or should otherwise be confused for investment, tax, legal, or other financial advice. We'll get into it right after this. This episode is brought to you by Ledger, the most secure hardware wallet trusted by 7 million users and securing 20% of the world's digital assets. We'll be hearing more from them later in the show. Hey Lightspeed listeners, we need your help. Lightspeed is conducting an audience survey to help us get a better picture of who our listeners are and what you want to see from the show. Think of this as our annual review. What do you like about the show? What could we improve on? If you want to contribute, visit the link in our show notes to fill out the survey and help us make a better show for you. Hello and welcome back to another episode of Lightspeed. I'm your host, Jack Kubinak, of course, alongside Mert Mumtaz. And today we have Tushar Jain, the co-founder and managing partner of Multicoin Capital, which was an early investor in Solana and still very active in the ecosystem today. Tushar has been there since the beginning, so it's really an honor to have him on today. Tushar, thanks for joining the show.
Thanks for having me back. I always have really fun conversations on here, so excited for this one.
Well, and this one is going to be extra fun because this is a kind of exciting, exclusive Lightspeed. So we're recording this a little ahead of time, and by the time this show goes out, there will be a proposal up that you wrote to change Solana's inflation rate to be market-based instead of the current kind of preset curve that inflation is on. This is something that on the show we've talked about as something that potentially could change in 2025, and that day is officially here, which is very exciting. I would imagine this proposal is going to meet some scrutiny, some discussion online. So I just want to begin the show, Tushar, by giving you space to make your pitch. So I'll just simply say, why does the Solana inflation rate need to change, and why is your market-based mechanism the best solution?
Thanks. Yeah. To kick it off, I would just say that we need to look at the history of how we got here. And how we got here was Solana's emission mechanism was a fixed time-based formula that the team came up with at the beginning. And it wasn't something that was particularly thought about from first principles. I've talked to Toli about this. He was like, this isn't the biggest problem that we need to think about. It doesn't really matter that much. We need to worry about like making the network function. So we're not going to waste our time on this, which, by the way, I have to commend Toli for generally very good at knowing what is worth spending attention on and what is not at that time. And so the inflation curve, I believe, was just borrowed from Cosmos, who had put some thought into it. But it's a very fixed inflation curve. I think that basically all the chains in crypto have this thing I would call Bitcoin hangover. And by that, what I mean is like the emission schedule of Bitcoin is sacrosanct. It cannot be touched. That is like the fundamental thing that makes Bitcoin Bitcoin. However, Solana is not trying to be Bitcoin. Solana serves a very different use case. And so I think the emission schedule for Solana can be changed if we have a reason to do it. And we have precedent in that Ethereum changed their emissions in a meaningful way. And that was something that the market was willing to accept and was very happy with. So that's kind of the precedent, the background that I want to talk about. And then to summarize this proposal, our idea is to make the emissions rate driven by market forces. Right now, we emit the same amount of tokens no matter what the market conditions are. If everyone wants to lock up and stake, we emit the same amount. If no one wants to stake because they're worried about the lockup and they value liquidity more, we emit the same amount. And this is really imprecise. It's not market driven. It's like fiat driven. It's just something that someone came up with at Genesis. And so what we're proposing is moving to a smart emission schedule, which would dynamically incentivize participation or staking when the stake amount drops. And that way we can incentivize securing the network at the times that it needs it the most. And also, this allows us to minimize SOL issuance to the minimum necessary amount to secure the network, rather than emitting more than is absolutely necessary.
So that is perhaps the abstract, if this is to be a paper. Let's start from the beginning. So, correct, Solana did basically just take Cosmos's issuance curve. And the reasoning at the time was, well, there's a lot of other things that could break. Let's just use what already works to minimize one variable that we have to keep track of. But although most people would probably be familiar with what inflation is and what inflation schedules are, how emissions work, all these things, let's first frame those. So within the context of Solana specifically, not Bitcoin, but Solana specifically, when we talk about emissions or when we talk about this inflation curve, what are we referring to and why does that matter?
That's a good question, and thanks for bringing me back to the basics there. Look, on Solana, you can stake your SOL tokens to a validator to help secure the network. The validators are the ones who are proposing blocks and voting on blocks to propagate state throughout the network. And they need to be rewarded for doing that. The validators need to be rewarded, and so do the stakers, because the stakers are locking up their tokens when they stake them. There are two primary ways that stakers and validators are rewarded. The first is through transaction fees, tips, priority fees, etc. And then the second is through inflation. And by inflation, what I mean more specifically is the network mints new tokens to reward those stakers. Validators take a commission, and that's the validator staker split. So at Genesis, the Solana network had 500 million SOL tokens in existence. Now we're approaching 600. We're still a little below 600. And that's because the network has been around for a few years, and that's the effect of inflation over those years.
Celebrating 10 years of innovation, Ledger remains the most secure hardware wallet for your Solana and logins, trusted by 7 million users and securing 20% of the world's digital assets. In recent years, Ledger has built a robust ecosystem of products and services, making digital ownership more secure and accessible to everyone. Ledger's newest devices, Ledger Stacks and Ledger Flex, feature the world's first secure touchscreens, making it easier and safer to manage your Solana transactions and coins. With Ledger Live, you can seamlessly and securely manage and stake your SOL. Alongside Ledger Stacks and Ledger Flex, Ledger introduced the Ledger Security Key app, a safer alternative to traditional passwords, enhancing your overall digital security. Thank you to Ledger for making today's episode possible.
Let's look at maybe the effects of what happens when you play around with those numbers. So it starts off high, perhaps to incentivize more people to create blocks or be validators, but also to stake. But it seems at this point in time, a very common line of thinking is something like, well, this coin is inflationary, therefore it's a shitcoin like fiat, and therefore the network is debasing me. All sorts of weird analogies, let's say, Kyle's favorite thing. What are some of the ways you see people get this wrong, and how do you personally think about them? What's the framework?
I think inflation in crypto is pretty different than inflation of like fiat currency. And the reason is that anyone with SOL tokens can stake those tokens permissionlessly and participate in that inflation. That makes it just meaningfully different than any comparisons to fiat or to stock-based compensation at big public companies, where you as a shareholder in Nvidia or Apple or MicroStrategy or whatever cannot stake your stock and participate in the inflation from stock-based comp. So in that sense, like, I cringe at the thought of people saying inflation is a cost to the network, because if you're able to permissionlessly participate in that inflation and it's open to everybody, then you're not getting inflated away if you stake. However, that doesn't mean that inflation doesn't have downsides. And there are a number of downsides to inflation that are not this like cost to the network idea. The first one is probably the most powerful, which is in markets, sometimes perception is as important as reality. And while I don't think SOL inflation is a actual cost to the network, some people do think it is, because inflation causes long-term downward price pressure, assuming the FTV stays the same. So to give a really simple example, if your FTV is $100 billion and you have 500 million tokens, that's $200 a token. If you have inflation over some period of time to double the number of tokens to 1 billion tokens, but the FTV stays the same, well, your chart looks like it's a down-only chart. And that psychologically matters. Like, perception is an important thing in markets. The second big downside of high levels of inflation are because some stakers in some jurisdictions have taken the interpretation that staking creates ordinary income on which they must pay tax at the time that the staking income is created. And that applies to some percentage of the stakers of the network, and they are selling a portion of their staking rewards every month or every so often in order to pay those fiat taxes. So the inflation is actually contributing to net new selling pressure in order to fund those tax payments. And that, once again, exerts downwards price pressure on SOL. And then more abstractly, I would say reducing inflation could spur more SOL usage in DeFi, because having a high inflation rate is like having a high risk-free rate for the primary asset in the Solana network. And when I can just earn 8% by staking my SOL, well, then that increases the hurdle that a new DeFi protocol has to meet to get me to put my SOL there. Whereas if the inflation rate is lower, that's lowering that hurdle, and you could see DeFi applications do much better. And ultimately, that's the goal, right? Like, we want DeFi to do really well. We want applications on Solana to do really well. And I think lowering the inflation rate can lower the hurdle for people to participate in DeFi.
I think there's an interesting question there as far as what is the goal. Is it just price appreciation, or is it get the SOL, the asset, to be more productive in DeFi? So I want to get into that. But first, just one other question as we talk about some of the initial implications of changing inflation is, does lowering inflation harm Solana in that staked SOL becomes less attractive as a yield-bearing asset? So, like, my normie friends that invest in Solana look at it and they say, hey, I could go stake with Helios and get 8% APY or whatever it is right now. As opposed to ETH, if I stake my ETH, I get, I don't know, 4% APY. And so there's this sense of like, it gives you a higher yield regardless of the price action. So that to me seems to be the obvious trade-off here is maybe there's a perception in the market that there's less inflation, and so Solana is scarcer and the baseline price will go up, but the yield for staking would go down, to my understanding, if you reduce inflation. And so is there a trade-off there, I guess, and how do you think through that?
That's a good question. I would say I disagree with that, but let me explain why. I think you have to look at the world with everything else equal. Like, if you assume that the FTV of SOL is flat, then the staking rate isn't actually creating any wealth for anybody. What's actually happening is you have 10% more tokens and the price of tokens went down by 10%. And that isn't actually creating net new wealth. So that would be my first point. And second, I just want to back up and give people a framework, a mental tool that I like to use for problems like this and a lot of other problems, which is reasoning by extreme analysis. So imagine that Sol actually had an inflation rate of 10,000%, like the supply 100x's every year, right? You could say, oh man, I'm going to get a great yield by staking to this network. But like that's clearly not true, because if the token is 100xing every year, like you should expect, all else equal, the price to come down by 99% every year, right? So when you take things to their extreme, that can help reveal the change that happens based on directionality, right? So on the other extreme, if you send inflation to zero, well, that might be pretty harmful to network security, because while MEV yields and fees being paid to transact are getting to be quite significant, I wouldn't say that they're quite there yet, that they would incentivize staking on their own, right? So I think reasoning by extremes at like the zero bound and then the 10,000% bound helps you think about, okay, if I move up, what are the effects? And if I move down, what are the effects?
And then obviously, as you mentioned, in his episode with Mert a couple months ago, Anatoly basically said, look, inflation's just accounting. Like you said, Tushar, there's no wealth created. It's sort of moving assets from this stakeholder to this stakeholder, and who should receive, or who should be propped up by our inflation schedule, essentially. So just to go to first principles here, Tushar, like what is the point of inflation, or I should say, what is the point of Solana, the asset, as we think through inflation? Like, is the point for the price to go up? Is the point to meet the ideal staking percentage? Is the point to be as secure as possible? Like, what do you think is the primary point of Solana as you think through inflation?
From a technical perspective, the point of Sol, the asset, is to secure Solana, the network. And that's why it exists. And security is important for all of the apps that build on top of Solana, whether it's payments, DeFi, DePIN, DeSci, NFTs, et cetera, et cetera. There's so many different categories. They all need security and they need finality. Without Sol, the asset, Solana, the network, could not deliver that security that's critical for the apps. But the point of Solana as a network is to serve the apps that build on top of Solana. Like that's why we're here. I'm not here for the just like play gambling games with each other kind of ethos. Like I'm here for, let's build technology that allows human beings to coordinate economic activity and creates wealth. And I think one important prerequisite for that to happen in crypto is you need to have a secure, scalable layer one protocol. So let's get into like, what does Sol actually do for security on Solana? And the security comes from really one major thing, which is the potential for slashing. If Sol, the asset, is economically valuable and a validator misbehaves, like let's say signs two conflicting block headers as the most simple cryptographically provable way that a validator can misbehave, well, then they can be punished by the network by having their stake slashed, and that makes misbehavior expensive. Whereas if you don't have this, then misbehavior is free, and you would see a lot more of it. And so in order to be able to punish misbehavior, you need Sol, the asset, to be valuable, and you need a sufficient amount of it to be staked in order to be able to sufficiently punish the potential misbehaving validators. And while slashing is at more of a theoretical stage right now in basically every proof of stake network, I do believe that ultimately it is the threat of slashing that keeps validators in line. I think that is the ultimate reason why validators behave properly, is the risk of slashing.
It's also worth noting that misbehavior doesn't have to be related to security. It can just simply be spamming the network, right? So Toli will talk about the token as a spam mitigation mechanism. And on Solana, you can allocate accounts, or you must allocate accounts when you're working with tokens. And if you can do that for free, then you can overload the validator's memory or disk space for free, which is misbehavior. So I think that's a good framework put in place to start thinking about the actual proposal. So currently, the inflation is constant or fixed with respect to time and time only. And you basically are saying, well, that's arbitrary and not perhaps first principles reasoned. And why don't we make this market driven instead? And so let's discuss what it means to be market driven. How does that work? First, let's take it very simply and assume we're talking to the DGen audience, and then perhaps we can get a little deeper.
Right now, the network just has a fixed curve. It's very simple to understand. However, in order to change it, you have to understand the relationship between several variables. And the variables are the yield for stakers, the issuance rate of SOL, like how much SOL is being minted and rewarded to stakers, how much SOL is staked, and then what is the MEV return to stake. And these variables all work together in an equation which I put forward in the SIMD. To break it down very simply, though, I would say the yield for stakers is equal to the emission rate of SOL divided by what percentage of the network is staked, plus the MEV yield. So to give examples, if you have 10% of SOL is emitted, so let's say we're at 500 million SOL tokens in total, we have 50 million SOL tokens being emitted, and let's imagine only half the SOL is staked, so 250 million SOL is staked. Well, then you have a 20% yield from inflation for stakers, plus whatever the MEV yield is. Let's say it's 2%. So you have a 22% yield for stakers. Now, as with any equation like this, you have dependent and independent variables. You have some variables that you are setting that are inputs, and then the others that you are calculating. Right now, what we have is we have the market drives the stake participation rate. We have a fixed issuance rate. The market drives MEV, and you calculate those three things together to get the staking yield. Now, we can think about changing that a little bit, and we can say, okay, well, what else could we target? Rather than targeting this level of emission, what else could we target? And our proposal is that we should target a staking participation rate. Because going back to your earlier question of what is the point of SOL, the asset? The point of SOL, the asset, is to secure Solana, the network. That's why SOL, the asset, exists. And so fundamentally, why do we stake? We stake to secure the network. If people are willing to stake, like let's say you have 70, 80% stake participation with a very low inflation rate, well, great. Like that's, it's very secure. You have that high level of security that you would want. In fact, I would argue you have more security than you actually need if you have 70% of the network staked. and you've accomplished your goal. So the way that we structured this proposal is we said, well, what is the amount of SOL that we think should be staked? Like, if we're going to target that, like, what do we think? And the number we came up with is 50% of SOL being staked. And so what we propose is, if more than 50% of SOL is staked, then we gradually lower the inflation rate. And if less than 50% of SOL is staked, then we gradually increase the emissions rate. And that way, we always try to target back to 50% of SOL being staked. And I think that finding that equilibrium will provide the fundamental reason that we have SOL is to secure the network, but also it'll address the motivations that I discussed at the beginning of this in terms of, having the psychological aspect as well as the tax selling aspect of inflation be mitigated.
How did you come up with 50%? Is that just a guess that will be error corrected with time?
So we did our best to estimate, right? Like, there's some questions around like, how much SOL do you actually need to be staked? My thought process here was, beyond 2/3 of SOL being staked, it doesn't add any incremental security guarantees, because a supermajority of all SOL has voted on any given block, and therefore a long-range attack is impossible. I think these long-range attacks are a very theoretical thing. Vitalik has written some good blog posts about it. This is not something that we have ever seen in practice. However, it is worthwhile to think about potential attacks when you think SOL could be, the asset that is securing the network for a significant amount of global commerce. And then having under 33% of SOL staked, we potentially risk network safety, because a supermajority of all SOL has explicitly not voted on a given block. And that opens the edge case possibility of a long-range attack. I'll try to summarize what I mean by long-range attack, because I think this is important, but this does get pretty technical, and I would recommend reading some of Vitalik's writing on it specifically, if you're interested in diving in deeper. What a long-range attack is you go back in time, and if you can get 2/3 of the SOL, let's say, 1,000 slots back in time, or 10,000 slots, X number of slots back in time, if you can get 2/3 of the SOL that existed at that time to be to sign a transaction that says that it was staked at that time, or intending to stake at that time, and then those validators that it was staked to sign a conflicting block, that many slots ago, then that is what would be considered a long-range attack. And now you have a conflict where you have two competing chains, one which has 2/3 of stake in that example, signing it, and the other one which has less, obviously. And that presents a real problem. Like, this is like now we have to go to the social layer of consensus in order to figure out, like, which chain is valid, which one is not valid. Like, that's really messy. So I think going below 1/3 is dangerous. I don't think a long-range attack is like super plausible, or it's not something that I'm like, oh man, this is going to happen next year. But I would be pretty scared if we went under 1/3 of SOL staked. By the same metric, though, if you have 2/3 of SOL staked, well, then a long-range attack, like I described, is fundamentally impossible. Because if you have a supermajority of SOL voting on all blocks, well, then there is no possibility of, like, you cannot acquire enough stake from, like, a past slot to then sign a conflicting block, which gets finalized. It's just empirically impossible to do. And so those are the upper and lower bounds.
Do you know the staking rate today? What number it's at?
We're at about 70% last time I checked.
So basically too secure within this framework.
Correct. I believe that we are over-emitting SOL for security. I think we're basically overpaying for security.
Okay. And so, okay, to summarize very quickly, you want to be the issuance to be market driven. And in this case, what we want to target is actually a staking rate as opposed to a pure APY number. And the implications are basically for security. So, and you have obviously before this was a SIMD, you had some discussions, you wrote it up, talked to some folks. I'm curious on what the feedback has been so far, and if you can perhaps steelman any strong opposition that you've seen.
The strongest opposition point that I've heard is like, hey, is this important? Like, do we need to change this? Like, do we need to even mess with this? Just leave it. And yeah, there might be some psychological cost to inflation. There might be some tax selling cost. Might present a higher hurdle to DeFi usage, but the inflation rate is decreasing every year anyway. And touching inflation is problematic to some people. And that's the Bitcoin hangover, in my opinion. However, I don't think this is the most important problem for Solana to be solving. The most important problem, in my view, is performance. It's, increased bandwidth, reduced latency. That is the most important problem. However, I believe the network has now gotten to a level of maturity that we can walk and chew gum at the same time. We can think about two separate things at the same time. We have some great engineers working on the network performance side and network stability side. We're seeing tremendous progress there. And I think we can, in parallel, work on economics for the network without distracting away from what is the North Star, in increased bandwidth and reducing latency. That's really the main negative feedback that I've seen on this proposal. Everything else is very straightforward. Everyone understands the idea of targeting a staking participation rate. People are familiar with the idea of funding rates on perps, which are obviously one of the most popular contracts in crypto. If you have the perp price deviate significantly from the spot price, the funding rate forces it back in line. And that was the direct inspiration for this proposal. It's a construction we know works at scale over very long periods of time through extreme volatility. And so I have complete confidence that we will be able to target a staking participation rate and use emissions to have the network get to that participation rate. The technical implementation here doesn't seem incredibly complicated. This is not some huge risky change that we're making. The main concern is just do we want to even bother touching this? Is this above our bar?
Mm-hmm. One piece of context I think also that might just be helpful for listeners who are less familiar. When Solana first began emissions, the inflation rate was set at 8%, and it decreases by 15% every year. And this is the current model, and it's going to plateau at 1.5%, which will happen in 2030 or 2031 or something like that. And the current Solana emission rate, when I last checked, is about 4.7%. So, and I believe your proposal sets the max at 4.7% and the minimum at 0. So we're talking about somewhere in between those bounds in the current world. One thing I want to ask you about, Tushar, I think there's an interesting conversation to be had about MEV as a source of validator revenue here. So there's an aside in the SIMD somewhere where you say the market-based adjustment give you a lot of flexibility. So you could imagine a world where most validator revenue comes from MEV and emissions actually go to 0, because I guess what would happen is the staking rate would be above 50% and you keep lowering the emission rate to try to drive it closer to 50%. But the MEV rewards are so high that people still want to stake SOL to get a piece of the MEV reward. And so there's no Solana inflation. It's just flat. So, and I guess to throw out some helpful context, just MEV as a proportion of like validator income has increased a lot over the past year. One Dune dashboard I reference a lot is like it's at like 33% of the validator staking reward, where it used to be like, I guess, nothing, just about. So walk me through the MEV implications here, and yeah, what would that potential zero inflation world look like?
I think you described it very accurately. If the MEV is sufficient to attract enough stake to secure the network, then why do we need emissions? What are we accomplishing with emissions? We're not accomplishing anything. Those emissions have absolutely no upside, like full stop. There's no reason to emit in that world. And that is, in my opinion, the ultimate vision for Solana, is that Solana as a network is generating enough economic activity that it is economically rational for people to stake in order to participate in the MEV. And the long-term equilibrium that I expect will happen under this type of proposal is a 0% inflation rate, because people are incentivized to stake just for the MEV. Now, I do want to caution, we cannot target a staking yield inclusive of MEV. I think that's fundamentally impossible, because then you're just incentivizing those priority fees and tips to go out of band and people to have backroom deals with validators. And you just cannot measure the amount of MEV on the network with precision in a trust minimized way. You can estimate it. You can do a lot of calculations on it. However, if I call Helios, and off chain, pay them in order to include my transaction when they are the leader, then like there's no on-chain metric that you can use to track that. So I don't think we can actually, in a cryptographically verifiable way, track what MEV yield is. That's why I think we need to target staking participation and let the market decide, hey, what MEV yield do you think you're getting? What is the yield that you need to get? And you'll stake if you're earning more than your opportunity cost, and you won't stake if the yield is lower than your opportunity cost.
There's another variable here that's going to be in play perhaps within the next few months, which is SIMD 96, which is that currently the way it works is half of the priority fees are burned. And with this proposal, that burn will be removed. In fact, it will just go to the validator, and perhaps the validator will share it back with the stakers, or they won't. How do you foresee that playing with the inflationary mechanics of the chain today?
I think SIMD 96 is a good idea, and I am supportive of it, because in the current paradigm, it is a better strategy to find off-chain ways to pay the validator for transaction inclusion rather than doing the priority fee, because right now half the priority fee gets burned. And so if I had to pay you 1 SOL to include my transaction, I would have to either pay a 2 SOL priority fee where half gets burned and you get 1 SOL, or I could just pay you 1 SOL directly. And that's just a weird incentive. So I'm very supportive of SIMD 96. However, it is important for us to understand the effect of SIMD 96 will be that the amount of SOL burned will go down. It's going to decrease, and SOL will be more net inflationary post SIMD 96 than it is today. And so if we do end up passing this inflation reduction SIMD, which I am proposing, that can help mitigate some of the inflationary effects from SIMD 96.
That aside, I just, want to hear you get into a little bit. What are the downsides here? Like, with any change in how a thing is governed, there's different stakeholders that win and lose differently, and there's different risk vectors that are introduced. So as you were writing and thinking about this proposal, what do you think are some of the potential risks or downsides, and how did you kind of try to minimize those as much as possible?
It's my job to think about risk a lot, and it's something that I spend a lot of time on. And honestly, I struggle to see meaningful downsides here because we know what Sol the asset is needed for. We know that we're overpaying for security today. Like, we have more Sol stake than we need for securing the network. And while inflation is not a cost in the way that stock-based comp is a cost, or monetary issuance could be perceived to be a cost in fiat currency land, it is a cost in other ways. And if we are having that psychological cost, if we're having that tax selling cost that we can remove without harming the network at all, then that just seems to be a true net positive. To really focus on the only possible negative, and I talked about this before, is just you're messing with the emission curve. And if you think that our goal is to go and beat Bitcoin, then messing with the emission curve basically makes it impossible, right? Like, we will never be able to say, hey, Sol is, hard money, digital gold, with a verifiable fixed supply that can never, ever be changed if we go mess with the emission curve, right? Because if right now I have this proposal to lower emissions, who knows, in 10 years, maybe there's a reason that there's a proposal to increase emissions, right? I don't know what the future holds. And by doing this, we are opening the door to having those conversations if we need to have them. I don't see this as a bad thing, because I don't think Solana is Bitcoin. I don't think we're competing with Bitcoin. I don't think we're trying to do the same thing as Bitcoin. And so closing the door to being digital gold or ultrasound money, or whatever the catchphrase you want to use here is not something that I perceive as a cost. Though others in the Solana ecosystem who have diverse views, who might actually see Sol as competing with Bitcoin, may see that as a cost, because we're opening up conversations about issuance now and again in the future.
You talked about how, Solana's initial emission curve was inspired by Cosmos. Cosmos now, to my understanding, has sort of a market-based emissions curve, and it's been the subject of governance recently, where they lowered the minimum inflation, I believe, and so that less atom is emitted. So with Solana and its sort of Cosmos ties, did you look at their example of this as inspiration for the proposal you're bringing forward now? And are there any learnings from that?
I did look at their proposal. However, the influence on my proposal was really thinking about how perp contracts work. I think perp contracts are one of the most elegant financial constructions out there. And we have data. Perp contracts are tested with extreme volatility, very large amounts of money on the line, and over a very extended period of time. We're not relying on 6 months or a year of data. We have a decade plus of data on how the funding rate on perps contracts keeps the derivatives price in line with the spot price. And that's the direct influence here. So I think the mechanism is very well understood. I think it's been in practice for a long time. And I think from first principles, this is the right way to think about emissions.
So I want to get to long-term staking, but I want to play devil's advocate first. So assume you release this SIMD, which by the time this is released, that will have happened. Now further assume I'm a grumpy core dev, Trent. And let's say we agree inflation is too high today. But let's say I believe that it's somewhat of a complicated implementation it is just one equation, but perhaps it's a bit more complicated than it needs to be. Why not just cut the inflation in half and hard code it in?
That's a great question. I think we considered this when we were putting together the proposal, and I don't think choosing a fiat inflation curve is the right thing to do. It's just as arbitrary as the initial curve, where we are saying like, hey, we as the people in the ivory tower who think about this stuff and write proposals and stuff, like, know what the market should want. Like, we think that the market is going to be happy with X, and we don't know that. Like, the market is a big, diverse group of people who all have their own individual incentives and their own stories. And I think markets are the best mechanism in the history of humanity to set prices. Emissions rate is a price, like that, in an abstract sense. Like, this is a price. And one like core belief I have is we should use markets to set prices wherever possible, and only interfere with the market setting prices in extreme cases where it is absolutely necessary. So I think cutting the inflation curve in half or doubling it, or just coming up with some modifier and setting another fiat curve is arbitrary and doesn't accomplish the goal of letting the market speak. And I think our current proposal lets the market speak. If the market is okay with 0% inflation because the MEV yield is sufficient, fantastic. If the market says, no, like, we need higher inflation because the opportunity cost of staking is too high, then great. Like, we are able to respond to the market conditions without having a big governance decision about it. Like, let's say we cut the inflation rate in half, and then all of a sudden the staking participation rate drops to 30%, and we're like, oh my god, this is terrifying. Like, this is pretty, what did we do? And then we have to have a whole other conversation about, actually, let's bring it up by 50% or 100%, right? And like, that's just really messy and awful. Whereas coming up with a market-based mechanism, if the staking participation drops, it'll automatically increase the emissions rate to incentivize more staking.
But speaking of extreme market conditions, you've hinted at the fact that there is a second SIMD that you have coming, which addresses long versus short-term staking, I think sort of to address some of this potential instability with how quickly you can unstake SOL. So can you just walk us through what that is and the motivation behind it?
Absolutely. This proposal is a separate proposal. So I want to be clear that this inflation reduction proposal stands alone. And I think it is a fully self-contained proposal. The second proposal that I have is around long-term staking. And that is not yet released, though I did write a blog post along with my colleague Vishal, who I want to give a shout out to as being co-author on this proposal, as well as on long-term staking, and an incredible thought partner on this stuff. But now, with that preamble aside, because I don't want to tie these two proposals together too tightly, like they are separate, let's talk about what is long-term staking and what problem does it solve. One big problem that I see with the Solana network from a security perspective today is that everyone can unstake within an epoch. There's some limit, I believe, to only 25% of the network can unstake in an epoch or something like that. But that just means that within 4 epochs, you could have the whole network unstake. 4 epochs is just not a very long time, right? Epoch is about 3 days. You're talking about less than 2 weeks, even with that gate in place, that the whole network can unstake. And if there's no stake, security is obviously harmed. Right, you need staked SOL in order to finalize blocks and secure the network. And so I think that there should be a market-driven mechanism that allows people who are staking to choose how long they want to stake for. And if they're willing to stake for longer, they should get compensated for doing so. For example, if I'm willing to stake for a year, now there's some market panic something happens, some big market crash, black swan event happens, I cannot unstake. My Sol is still there securing the network. And I think that just mitigates some of the security risks from a crazy black swan event. We are working on a formal SIMD for long-term staking, which we'll release later this year. However, for now, I think the inflation reduction SIMD should be the focus. And we will wait until this is resolved and we get feedback from the community on whether we want to do this or not before we go approach long-term staking.
How does that interplay with liquid staking?
I expect that almost all staking will be liquid staking. And people will be using stake pools for that. However, it's important to remember that liquid staked Sol, like let's say Jito Sol, is not exactly the same thing as Sol. It is a wrapped version with some trade-offs, right? It has yield, but it has less liquidity. And that's going to be the case for any liquid stake token. And so I would imagine with long-term staking, like let's say we allow for 1 year staking, that will be done through a liquid staking protocol. So maybe you have Jito Sol 1 year as like a new liquid staking token that is created. However, you can't just redeem that immediately for its face value of Sol. If I have 100 Sol staked for a year through this long-term liquid staking token, I can't just sell that for 100 Sol. I have to sell that for what price the market will bear. So, and if I'm panicking during a black swan market crash event, maybe I'll sell my 100 Sol long-term staked for 90 Sol now. And that way I will still have the ability to have liquidity, but I'll have to pay for that liquidity. And this is similar to how, longer duration bonds work, where you can't just call a bond, most bonds. You can't just say like, oh, I want the money back now. But you can sell the bond to someone else. And, when the bond actually matures, then that person is the one who collects that payment.
So you guys have a post on this on the Multicoin blog. I tweeted about it, I believe over a year ago now, or it was during the Amsterdam breakpoint, if I remember correctly. And I tweeted it, and I don't fully remember all the feedback. I should have looked at it before this episode, but it wasn't all favorable, and there was some pushback. And some folks, I believe Avalanche said they already have this. I don't quite remember if that's true. What's some of the pushback you've gotten on this, and what do you think they get wrong?
One of the pushbacks that we get is, hey, like, you're a big VC firm, you have a big hedge fund, you have the ability to hold for a longer period of time. And so you're just looking to get more tokens for yourself. Like that's the number one pushback that I've gotten is, hey, long-term staking is a self-interested proposal for Multicoin to get more tokens. It really isn't, because the first proposal that we're actually putting forward is reducing the inflation rate, reducing the emissions that we get for staking. The primary motivation here is just, I don't want to see a run on the bank again. We have seen this happen before, right? Like during the FTX crisis, we saw a massive amount of Sol get unstaked. And that was a huge source of FUD for the community. Obviously, that was a huge black swan event, but there will be black swan events again in the future, right? Like I'm thinking 10, 20, 30 years out, like we're going to have more crises. And I want to make sure the network can be stable through those crises. The other main concern that I got was, hey, I want to get the highest yield possible, but I don't want to sacrifice liquidity to do it. Like this feels unfair. And my answer to that is you'll be able to use liquid staking tokens in order to get the best of both worlds, as long as you're not trying to panic sell in the middle of a crisis. liquid staking tokens will offer you the best of long-term staking and short-term liquidity.
So this is a bit of like an out there one, but as I was thinking about this proposal this morning, I was thinking that there's an interesting comparison here to like what you've basically built is something like an algorithmic central bank. So in the same way that like the US Fed will kind of control monetary policy by raising and lowering interest rates based on how hot the economy is, this does the same thing. So do you see like to I don't know, be rhetorically maybe very grandiose here. Do you see that as like almost a new way to govern like monetary policy with, hey, you know, we don't need Jerome Powell to look at a bunch of charts and decide what he thinks should happen to rates, and we also don't need these like pre-programmed arbitrary inflation schedules. We can just have markets settle everything.
Yes, absolutely. There's actually a concept about this in traditional central banking. It's called the Taylor rule. And the Taylor rule is basically an algorithmic way to set the Fed funds rate and decide what's going to happen with monetary policy. This is something that's often discussed, however, is not officially in any governance. And the Fed governors get to vote and decide what the rate is going to be. I don't like that model at all, right? Like I fundamentally think that humans are corruptible. I don't think that humans should be making these types of decisions, especially not some small set of unelected humans getting to decide some of the most important financial variables in the world is insane to me. I think we should let markets make these decisions. Markets are the best way to combine information from all parties who are involved. And you find what the market clearing price is, and that's how you should set this stuff. And if I could propose a way for the Fed to change how it sets rates to be market driven, I would. I just think they're not going to ever give up that power. So I will save my breath.
I believe we've talked quite a bit about staking. And so for my final question, I want to talk about MEV quickly. So a few months, I believe it's been a few months ago, we started hearing about increased MEV activity on Solana, or not increased MEV activity, but increased malicious MEV activity. And we looked into this, Jito's looked into this, a few others have as well. We wrote a report on it that came out last Wednesday or something. So on the Helios blog, if you want to check that out. You guys are obviously pretty, let's say, opinionated about MEV. I believe one of your theses is that it's the ultimate form of, or it's the eventual form of value accrual for the blockchain. But also you have invested in things like Jito, I believe, Bloxroute or Fastlane, one of those two, no?
Fastlane, yes.
Yeah. DFlow as well, which they have a new swapping thing out that we're using. Pretty fun. What do you make of the whole MEV environment on Solana today? And what do you think is kind of noise and it's just short term? And how do you think it plays out in the next 2 years?
I think there are two different kinds of MEV, and we do need to separate them. One is malicious MEV, and this is front-running users. If you are front-running users, I consider that malicious because you're basically taking money from the user. You are giving them a worse fill than they would have otherwise gotten. And I think we should find ways as a network to fight malicious MEV. And we have a number of mechanisms that we've discussed on how to do that. But then there's also the inevitable type of MEV, what I would call beneficial MEV or good MEV, which is the fees that are earned by the validator for including transactions that keep prices in line. If the price of the same token on Orca and Radium is different, then there's an arbitrage profit to be made. And I believe that the validator who processes that state transition should get paid based on how much arbitrage profit is there to be made. And this is not harming anybody. In fact, this is benefiting everybody because it is bringing prices back in line and keeping the market efficient. So let's talk about the future of MEV and how I think it's going to evolve. One, I think we are going to see much more robust reputation systems for validators and how they behave. I think that if you are a sole staker, either you should stake with a validator who you trust, who you believe is going to behave properly for the long-term interests of the network and your sole tokens, or you should delegate your stake to a pool like JitoSol that is incorporating that information and spreading out your stake amongst a bunch of validators. So, we stake with Helios. We think, Helios is a great actor. We stake a lot with Jito. And I think if you are staking to a validator with a bad reputation, you are harming the network and yourself. Because at the end of the day, like, the network is valuable if we have activity on the network. And if you have a ton of malicious front running of users, they are going to go elsewhere. You can't just bleed users and be so short term about it. So I'm very strongly supportive of validator reputation mechanisms. The other big thing that I think is going to change is, I think the market structure for these assets is going to change. And there are two proposed ideas that I'm quite excited by. The first is DFlow's conditional liquidity idea. And the idea for conditional liquidity is there are wallets who get to, like Phantom or Backpack, etc., who get to verify that a transaction was initiated by a real human user. And if the transaction is endorsed as having been done by a real human user, then it gets to trade against a pool that bots cannot trade against. So the front-running bots cannot trade against this pool. They cannot trade against this price. They cannot front-run you. And you, as a regular user, can trade here. And basically, like, what's happening is you're permissioning access to that liquidity such that only endorsed orders from real users can access that liquidity. And this reduces any chance of front running. The second proposal that I also find compelling is from Ellipsis, which is an auction-based proposal. It's a new type of DEX, basically, that says everyone within a certain number of slots is going to get the same price. So it doesn't matter if my transaction lands right in front of yours or right after yours, we're going to end up getting the same price. We look back, for example, like, let's say we're looking back just at this one slot. Everyone in the slot gets the same exact price, or everyone in the last few slots get the same exact price. Now there's no incentive to front run. Basically, what you're doing is you're transforming the first come first serve order book into an auction and destroying the incentive to front run. I think both of these approaches are really promising. I think both of them are pretty far along in development, and I think that they're going to meaningfully mitigate negative MEV. So, I'll go out there and make a prediction. I think 2 years from now, these mechanisms will be in place for the majority of retail transactions on chain. And I think that the MEV that will exist will be primarily what I would call the beneficial MEV of keeping prices in line, of processing liquidations in a timely manner, and those types of transactions.
Yeah, it's going to be really interesting to watch in 2025 how the MEV problem evolves, for sure. Tushar, thank you for coming on the show. It's been a really interesting episode. It's been fun to kind of just get to talk through what is going to be a really consequential proposal for Solana. We're releasing this at around the same time that the SIMD comes out. And there's, Solana validators, community members that listen to this show who maybe, hopefully this helped them make up their minds about what they think about the proposal a little bit, just gave them more information. I guess just last word from you, like, what's the bottom line takeaway? What do you really want people to get out of this episode as they begin to weigh whether or not they kind of support this proposal?
If you're going to summarize the entire episode to two things, these are the two things. The first is, I believe that we should use markets to set prices wherever possible. I think markets are the best way to incorporate information, and our proposal does exactly that by allowing the market to set the emissions rate for SOL. The second point that I want you to take away from this is, while inflation is not a cost in the same way that it is as for stock-based compensation in traditional companies, and John Charbonneau from DBA had a really good write-up about this. If you haven't seen that, you should check it out. It is a cost in other ways. It is a cost psychologically because people don't like charts that are, down and to the right. If FDV is constant and inflation is high, that chart is going down. And it is a cost because of tax selling, because of the interpretation that some significant subset of network participants have around staking being income. So I do believe that there are negatives to having too high of an inflation rate. And that's what we hope to correct with this proposal. So we appreciate everyone's consideration with an open mind. I know that this is touching something that some people may consider, untouchable. You don't want to go and mess with inflation unless you absolutely have to. And I hope that, the Solana community will think about these points and have a good intellectual debate about what is the point of SOL, the asset? What is inflation? What do we need to incentivize? What do we not need to incentivize? And I'm confident that the community will come to the right conclusion after some serious discussion.
Absolutely. Tushar, thank you so much for coming on the show.
Thank you for having me. I know this was a complex topic, and you helped me explain it to people in a way that I think will make it much more accessible. So I appreciate the opportunity.